We're here to talk about Silicon Valley real estate market conditions for the current week. Here is a summary of the slides we're going over sort of in the order. So a quick recap: marketing time, how long does it take 3/4 of the sellers to sell their property, sellers' expectations, how much price reductions do they have to take before they get their offer in the door, and then market competition, the buyer's overbidding. So those are the three first graphs, their weekly distributions. Then we get into 20 micro market areas, which I think is the real key. Because, yes, the media talks about the Bay Area real estate market. It's not the Bay Area real estate market. It isn't even Santa Clara County or San Mateo County or Alameda County real estate market. Each area, and I have basically 6 micro markets in each one of those counties, 7 on a couple of them, are moving at a different pace in different conditions. Then we do some comparisons where we show where the market's going, looking at the key indicators, number of active listings, offers, DUI, and then compare it to the 10-year medians. On the comparison, you can see the bounds of where the market normally is and where the market actually is the current year. Then we compare the 3 counties compared to each other, and then we finish up with how to participate, and then also the Greater Bay Area, which is 5 regions, 13 counties in Northern California. So let's get into the days on market. This is the time it takes 75% of the sellers to sell. Each line represents a week of data. We're starting off a year ago, which is this blue dash dotted line down here. The current line is the purple up here. So the market is quite a bit cooler this year than it was just last year. That means that it's taking longer for sellers to sell their property. Not significantly longer. Basically, it's 75% of the sellers are selling currently in about 27 days versus a number from a year ago of around 18 days. So it's 50% longer, but taking 4 weeks to sell your property instead of 2.5 weeks is still fully acceptable. But the key in this graph is to see how it moves. And as I said, we're starting off a year ago, and you'll see a year ago, and then 11 months ago, 10 months ago, and by months, I'm talking about either 4 or 5 weeks. You can see the market initially slows down, and then it speeds up when we get to the first of the year. So let's get this going. There we go. So you can see the movement up, big movement up there. Now a slight improvement, huge improvement, the peak of the market right there, and then sort of a coasting down into the summer. And that was the biggest coast. Now you can start seeing we're almost not going to change very much. Yes, the market is continuing to basically slow a little bit, but at the beginning of this movie, we saw that it was slowing down quite a bit. So what would a seller expect? The seller would expect the market to slow from its current purple line up towards these dotted lines where we were a year ago. And because the market's already cooler than it was a year ago, you'd expect it to be cooler than these dotted lines or higher than those dotted lines. I wouldn't expect it to reach all the way up to the dotted line up here. That would be a very cool marketplace. So that's sort of how you use this information. Same with seller price reductions. Now, the nice thing about seller price reductions is it's a very small number because sellers in general do their homework before putting on the home on the marketplace. So that's why we only go up to 17% of the market. So we're looking from 2.5% to 17.5% of the sellers. So we're only looking at 15% of the sellers that are taking the largest price reduction. So it's really not representative of the market, but we do this to see what's happening because the 85% or the 82.5% of those sellers that aren't on the market on the right side of this graph are basically taking no price reductions. And you can see the red dotted line up here, the hottest week we ever had, which was basically Valentine's Day of 2022. Sellers were simply not taking a price reduction. When I say that, less than 2.5% of the sellers were taking a price reduction. And the reason I drop off 2.5% is they really don't represent the marketplace, and there's a lot of data input error, and I want to keep that out of the data the best I can. The concept is the same. We're on the blue dotted line a year ago. Current is the purple dotted line, so you can see that we're quite a bit closer to the blue line, so we're quite a bit cooler than we were last year. But what does that mean? That means that, for example, 7.5% of the sellers this year are taking a 7% price reduction, where that same 7.5% last year was only taking a 6% price reduction. So the slowness that I'm talking about compared to last year is not very significant in most people's book, but it's still there. Let's step through and look at this. You'll see that it slows down. There's sort of the bottom of the marketplace to sort of in peak. Then you hit the first of the year and you have these huge run-ups, as you can see. There's the peak of the marketplace 5 months ago, then a huge slowdown. And now you're bouncing around sort of on the summer plateau. So there really isn't much change, and you can see there's some bounce. And now we're getting into those sort of the starting rate this coming week there. Now we're sort of clustered. The last 4 weeks have been clustered at the low point for the year. And what would someone expect? Someone would expect the seller price reductions to increase. Now, that doesn't mean that they will, but that's typically what the market pattern is. And that's why you look at it and you sort of hedge your bet in that direction. Now, anything can happen in the economy or in world events that will change what is most likely going to happen, but you plan for it. And how this helps you is it's smarter for a seller to be aggressive in their price reductions now if they're not selling versus waiting, especially when we see pricing coming up, and that will be a while down the road. Now we're looking at buyers overbid, much closer together. You can see the separation. The purple line down here where we are now is slightly cooler than the blue line from a year ago, but very close together. For example, if we come out to 50%, 50% of the sellers are receiving an overbid of about, I guess, it's a pretty broad scale because here's 100% and here's 10%, but I guess that's somewhere around 5% of the sellers are getting overbid, where a year ago that number would have been maybe 6.5%. So a third more sellers were getting overbids a year ago in rough terms. So again, let's step through and look at it. You can see the market slows down from this point to the end of the year. Right there's January 24th. Then you jump up. And there's the peak of the market on April 26th. And now you're starting to cool off. And the overbidding is a more stable index, but you can see it's just sort of floating down. And right now, and that's starting on August 2nd, you basically really haven't moved in any direction since August 2nd. So you've had 6-7 weeks now with no significant reductions or increase in the buyer overbid. It just basically varies a little bit from week to week. Now we're getting into the micro market areas, which I believe are the key. So you have 7 micro market areas in Santa Clara County listed 11 through 17, and they're abbreviated over here. I think their abbreviations are pretty clear. And if you need help with any of them, just let me know. And then you go in San Mateo County with 21 through 26. So you have 6 micro market areas, and Alameda County is 31 through 37 for another 7. And then my index is 41 through 44. So basically what I'm telling you down here is a shortage of inventory is from 50% to 87.5%. Now, of course, 40% is an extreme shortage, but I adjust the colors in this range. And then a surplus is from 112% to 150%. So yes, you can get more than 150%, which would be a huge surplus favoring the buyer, but I'm saturated blue because we rarely get there. And if you can see the marketplace, basically, almost everybody has no color at all, which means they're within 12.5% of normal. The exceptions of Foster City, which is a very small micro market area, and this one area up here, which is Campbell, Cambrian, Santa Clara, and Willow Glen, sort of in the center of Silicon Valley, which is sitting at only 69% of the inventory you'd expect, because that's lower than the 12.5%, the 87.5% of normal. It's a fairly heavy shade of red. Now it's about halfway between the 50% where I go saturated and the 87.5. And so that's sort of a medium shade of pink on there instead of a bright red. And it never really gets bright red, unfortunately. Moving on and doing the same thing with offers. Now, very clearly here, there's a huge difference here. Instead of being white, almost all the areas are blue in color, which right off the bat tells you we're lacking more than 12.5% of the offers. You can see Alameda County is missing 17%. You come up into Santa Clara County, and it's a little bit hard to guess all the different numbers because you got a couple at 106 to 107%, but you got a whole bunch at 85, and then a couple down around 70. Because it's, you can see that's white, which means you're around that 12.5% off, except for these two. So, maybe you're somewhere around 15, 17% of the inventory offers you'd expect. You go up into San Mateo County and you can see that it's a little bit more, and you're probably about 20% less offers than you'd expect. And as I said, Alameda County, because I don't have micro market data for the first 3 slides, is at 17% for the whole county. And you can see there's a blue tint to the whole county there. Moving on to DUI, this is the speed of the market. How quick would it take to sell all your inventory compared to normal? You can see that we're basically in Silicon Valley, we're basically at 100%. Yeah, you got half South County at 118%, but you also have the Campbell area at 82%, Los Altos, Palo Alto at 87%. So you're on both sides. And then on the high side, you have Saratoga, Los Gatos at 105%. And they're all pretty close to that 100% mark. You go into San Mateo County, sort of the same story. They're ranging from 125 in Redwood City, and down the highest I'm seeing is Foster Cities at 82%. Keep in mind, Foster Cities, Redwood Shores is a very small micro market area when you're only looking at single family detached and duet homes. Moving into Alameda County, and again, I don't have the micro market data, but it's basically at 104, 105% of the normal DUI. A higher DUI is a slightly slower marketplace. DUI is the time it takes to sell all the inventory you currently have at the existing rate of sales. We'll have a simpler measure of the speed of the marketplace coming up in a little couple slides, actually maybe 2 slides. So the first slide is days unsold inventory. So now instead of comparing it to the 10-year median, which is what the last slide was doing. So the last slide tells you, is it faster or cooler than normal? This slide just tells you whether it's fast, because in reality, Silicon Valley is a very fast moving marketplace, and you can see that. So even though we were slightly slower than normal in the other slide, or even normal, you can see your days unsold inventory in Santa Clara County is basically right around 3 weeks, with the long one being Saratoga, Los Gatos at just over, approaching 7.5 weeks, call it. For you to sell your entire inventory in 7.5 weeks is pretty amazing. A lot of the valley, the sort of the heart of the valley, is going to sell out in just over 3 weeks. Is a very fast marketplace. I consider 1 to 6 weeks to be a fast marketplace, 6 to 11 weeks to be a balanced marketplace, and anything over 11 weeks to be a slow marketplace. And if you move into San Mateo County, the expensive areas is a slow marketplace, as you're over that 77 days and you're up here at 109 days to sell your inventory. It's a little bit slower in San Mateo County. You can see you're probably averaging somewhere around, hard again to do the average, especially with you got 100 up here and then a 32, and then you get down to 17 days in Foster Cities and a 37. I would say the average is probably somewhere around 50, because you have 51, 60, and 105. But again, you have to do a weighted balance and on the fly, and not knowing how many sales there were in each area, it's hard to do that. Moving over to Alameda County, it's a little bit more balanced. You can see it's a slower marketplace. At least 2 areas here are 40 days, 29, 27. The fastest areas is 27, and the slowest is 92. So Alameda County is definitely a slower paced marketplace on the time it takes to sell out your inventory. Now, this is an easier slide for a lot of people to understand. It's simply how long is it taking 3/4 of the sellers to sell their property. And you can see in Santa Clara County, the slow area is South County at 49 days. So that's basically 7 weeks. Then you jump up to the heart of Silicon Valley, and you're basically at 2 to 3 weeks to sell your different micro market areas. The affordable areas being East, Central, and South San Jose at 26 days, and then Saratoga, Los Gatos at 29 days. So basically you can see that, 3 weeks, most of the sellers are selling their property. You price yourself a little aggressively, you should be able to do it faster than that. You price yourself aggressively and you probably won't sell aggressively on the high side. If you look at San Mateo County, their market's probably a little bit slower, because you're going 43 days on the coast, which isn't a huge marketplace. But then you have the north area, which is like Daly City at 31, and the fastest area, the Bay Cities, which is actually a fairly large area, at 14 days. Again, if I had to average all that out on the fly, I'd probably pick somewhere around 28 days. You come down to Alameda County, and there you're seeing from a low of Fremont of 20 days to a high in Oakland of 48 days. And again, probably somewhere around 35, maybe even 40, because you got 43 and 48, and then 28 and 20, 25. So probably realistically about 35 days. And actually the fast ones, Berkeley and Alameda, the island of Alameda at 18 days. Now we're looking at price reductions. This is where the seller's doing. And the first one I'll point out is Milpitas. And I talked about this a little bit last week, because it was a 0.3% price rise, which is unusual. So I dug into the data. And it is actual accurate data. What happened was last week, 5 homes sold, and they ranged basically from 7 to about 15% over the seller's ask price. And the seller raised their ask price to do that. They were different listing agents. It's just that's what you call statistical fluctuations. So this is sort of an anomaly because rarely do you get 5 people raising their price to match the overbid, but that's what happened and they were 4 out of the 5 were in the various areas. So that's why I dug into it even a little bit more, is to see them concentrated in a fairly small area within a micro market area was pretty unusual, but they were aggressively priced property. So to have it overbid is not uncommon. The uncommon part was for the listing agent to come back and raise the price. Some of people do that. They believe they need to do that to keep the appraisal up. I think that's ridiculous because the appraiser can go to the history and see. And that's the only area that's red in color. Everybody else is blue in color, which means sellers are taking larger price reductions on average compared to where they normally do, or compared to what their ask price was. Basically, from a 0.5% price rise to a 0.25% price reduction is a hot marketplace. From a 0.25% to 1% decrease. And the reason, again, it's so small is, remember, 85% of the sellers are typically not making any adjustment at all. And more than 1%, you start going blue in color. So you can see there's a lot of blue, 2%, 1.6%, 2.5%, 1.4%. They may sound like real small adjustments, but again, what we'll find in a slide is that it's only 15% of the sellers that are doing those price reductions. And here you can see this is the frequency. So how common are price reductions? And you can see in Cupertino, Sunnyvale, for example, only 3.4% of the sellers are doing a price reductions. Los Altos, Palo Alto, it's only 52%. But in the high area, it's South County, where you have basically 1/4 of your sellers doing a price reduction. And in the affordable areas, you have 1 out of 5 sellers doing a price reduction. Moving into San Mateo County, basically you're somewhere around 1 in 10 to 1 in 4 sellers, depending on which micro market area you're looking at. And you can see, in each one of the counties, you have blue and red within the county. So how do you talk about the market being on fire because you're taking very few price reductions in the heart of Silicon Valley, and then justify that being the same marketplace as South County, where 1 in 4 of the sellers are doing a price adjustment? We don't know how much that price adjustment is based on the frequency, but when you look at the magnitude, you can. Here's where the buyers are coming in and overbidding. This is the average overbid. The average overbid is higher than the median. Right now, the average is about 5% over. The median is about 3% over. And here's the breakdown in each county. You can see in South County, they're actually taking a 10% price reduction. Then most of the areas are somewhere right around 5. The high I'm seeing is Cupertino, Sunnyvale at almost 10% overbidding. In San Mateo County, the overbidding is a little bit more mild. You can see there's less red in this middle range. And in Alameda County is similar to San Mateo County, where you're taking basically 0%. Sellers are getting exactly their ask price in Pleasanton. After 2%, there's very little color because it doesn't get any color till 1.5%. Then when you start getting up around 3 and 4%, where a lot of the areas are, you're getting a fair amount of pink. Oakland, even though the price is low, their overbidding is 10%. In Alameda and Berkeley, it's 14%. Looking at the frequency of overbidding, this is how common it is overbidding. In Santa Clara County, you can see the low is, again, South County. South County is clearly not like the bulk of Santa Clara County, but you basically go from a high of 80 to a low of 54 if you're looking at just the north part of Santa Clara County, 44, as I said, in South County. In San Mateo County, you're going from basically 38% in the expensive areas to a high of 79, call it 80% for all practical purposes in the Bay City. So, doubling the overbid within a county from less than 40 to basically 80%, all within the same county, 2 completely different micro markets. And that's why, even looking at it county-wide doesn't make a lot of sense. Now, Alameda County is a little bit more uniform, but you still have 2 out of 7 exceptions, Pleasanton at 40% and Dublin at 50%. These are very close together from 60 to 80%. This is long-term appreciation. I was looking for a year period of time where I had stable prices. I only found the last 9 months of 2015. Here, red is the highest appreciation, blue is the least. So you can see Los Altos and Palo Alto and San Mateo County coast jump out as some of the lower ones. Down in Oakland at 40% is also pretty low. That's the low end of appreciation. The high end, 90% appreciation in Milpitas, 88% in Campbell. Come down to Fremont, 104%, Union City and Newark, 102%. So that's more than doubling your money in less than 10 years in real estate. So if you had purchased the property with 10% down, say, back in 2015, your house price of $500,000 would have doubled to $1 million, but your equity would have gone from your original $50,000 down to $550,000. That's why real estate's such a great wealth builder. Here's your sold price, and instead of following the median number, which is the middle number in each region, I follow the cheapest 10 percentile and the most expensive 10% in that area. And instead of color being favoring the buyer or the seller, blue is affordable, so low in price. Red is expensive, so unaffordable, favoring the sellers. You can see the expensive median price is $4.5 million. It goes from a low of 2.6, call it 2.7, to a high of 7.5 million. Yes, there's homes over $7.5 million in Atherton, but they're going to be less than 1 in 10. Here's a summary of all the slides you're looking, so you can start over on the left-hand side here in your different micro-market areas, or jump over to the right-hand side and pick either the payment or your affordability price range, and then look across and see the conditions that you'd experience. These are white in color because they really don't tell you by themselves what the market's doing. But now when you look at the DUI, it's the speed of the market. Is the speed of the market faster than slower than it typically is? Gives you an indication, but that doesn't tell you whether the market's fast or slow. It tells you whether it's faster or slower than normal. It's only when you start getting into the darker highlighted yellows that you really have true market indicators. The days unsold inventory, simply what is the speed? How long is it taking the sellers to sell their property? Are they adjusting their price more or less than they normally do? And then this is a fainter shade of yellow again, because the frequency tends to not change as much as the magnitude. So the magnitude, the average adjustment, is a more significant indicator than the frequency. Same with overbidding. But the reason these are now orange in color instead of remaining yellow is there's a time lag. We need to wait for escrows to close. And yes, the average time frame from an escrow to close is probably typically 5 weeks, maybe 3 to 6 weeks. But at the peak of the marketplace, the buyers that are most aggressive with their magnitude of overbidding are getting underwritten ahead of time. So they're coming in with 2 and 3 week closings. So the lag time of the magnitude is shorter at the peak of the marketplace than it is when the market's cooling. The long-term appreciation in each area, and then, as I said, the monthly payments, or the purchase price range and the monthly payments. Here's a summary slide. What I'm doing here is the current week is on the right-hand side. I go back 14 weeks, which is basically a quarter with a week on each side. So each of the vertical lines here is a week going back. So this is last week, 2 weeks ago, 3 weeks ago, 4 weeks ago, and then this is 13 weeks ago. This is 0 weeks, the first one, and that's why there's 14. I go back 13 weeks plus week 0. What it's doing is showing you have 2,700 listings basically right now. 14 weeks ago, we only had 25. But even though the inventory has grown, your percent change is pretty small. You went from basically 87% 14 weeks ago to 91%. So you've gotten a gain of 4% of the marketplace, even though your inventory has gone up almost 10%. Offers accepted is similar. And just for clarity, the red line down at the bottom is the hot marketplace. That's the least inventory you'd expect. The gray line is where you'd expect the inventory to be. So you can see we've been below where you'd expect the market to be. And the blue is the most inventory you'd expect. So the color codes are the same here, but the reason the red's on top is a lot of offers favors the seller. So this is the most you'd expect, that typically you'd expect. And the takeaway here is we've actually been at or below the least number of offers you'd expect. So the real story is the lack of offers. We're only at 81% of the marketplace, a quarter ago, we were at 77% of the marketplace. So even though we've improved on the market share, we've decreased in the number of offers. We've gone from 2,140 down to 2,100. So you've lost 60, roughly numbers. I'm just doing quick math in my head. And now you're moving on to days unsold inventory. You started off above, which is a slow marketplace, is the faster you sell, the hotter the marketplace. And now you're right on. But even though you've improved, you went from 117%, so 17% slower than normal, to exactly normal at 100.1%. But your days that it takes to sell has increased from the 41 on the left to 46.6, so almost 47. So you've had a slowdown of almost a week to sell out your inventory, but the market's actually improved compared to normal. Now the time, this is probably even more apparent, the time has gone from 17 days, fairly quick, 2.5 weeks, to 26, to almost 4 weeks. It's 50% better. But look, your percent of market at 102 currently versus 100 before is basically unchanged. We're basically following the normal pattern. So even though there's been a huge increase in marketing time, this is exactly what you'd expect at this time of the year. Yes, you slowed a little bit more here, but you're right back on for the last 2 weeks here. You can't follow it exact, even though it's a 10-year median. Moving on to price reductions. You're very much following the gray line, a little bit on the cool side of that gray line. We went from 0.8% price reduction to almost a full percent price reduction, 96%. So if I'm doing my math correct, that's a 0.14% increase in price reductions. And again, that these numbers sound very small, but remember, only 15% of the sellers typically participate in price reductions. But again, there's been an improvement. We went from 29% more price reductions than normal to only 10% more price reductions than normal. Price reductions are typically a negative thing from a seller's point of view. If we look at overbidding, where you were 1% above normal here, you can see you were above the gray line, and now you're 1.1% above normal. But the amount of overbidding has gone from 7.8%, almost 8%, down to 5.7, almost 6%. So the amount of overbidding has gone down. Now we're looking at a 10-year history. We're looking at the 3 key indicators compared to normal for all of Silicon Valley. So if you start on the purple line of inventory, you can see we're at about 90.5% of the inventory you'd expect. Your offers accepted are down here at about 84%, and your speed of the marketplace measured by days unsold inventory is about 97.5% of where you'd expect it to be. So the market is faster than you'd expect it to be, even though the number of offers is lower by a greater number. And that's because we're comparing the median of each one of these 3 items, the inventory to the inventory, the offers to offers, and days unsold inventory to days unsold inventory for the past 10 years, and their medians are happening in different years. Here now what we're doing, and again, or for the first time, I'm pointing out that in January 1st of 2023, I go from a condensed horizontal time scale to an expanded time horizontal scale, so you can see the trends better. So you have 2023 expanded, and the year to date in 2024 expanded. The previous 8 years are all condensed, so you can see the pattern. And this is the blue line is the 10-year median, the most inventory you'd expect based on our 90 percentile. This is where you'd expect the market to be, and the red is the least inventory you'd expect. So you can see 2023 had the least inventory you'd expect. Starting in the second quarter of this year, you gained a lot of inventory, but we're still below where you'd expect it to be. We may be getting to the point where we catch it on the cliff, but on the cliff, it gets more condensed, so you catch it even, most of the time you're going to catch it just because it's more condensed. Same concept now, but we take out the gray line and stretch it out, and you can see that you have a lower active inventory compared to normal, and low active inventory favors the seller. Now you're looking at offers accepted. You can see that we just spent the last quarter basically below. We were below the least number of offers you'd expect. Right now we're right about at the least number of offers you'd expect. Stretching it out, you can see that improvement, but you can still see we're about 84% of where you'd expect it to be based on the last 10 years. This is the speed of the marketplace. Here, you're almost dead on. You're a little bit below, so you're a little bit on the hot side of the marketplace. Now what we're doing is taking the gray line on the previous slide and stretching it straight out. And you can see that the market's improved and we're now down below 100%. So we're slightly faster than typical. If we were having a typical market, you'd be on the gray line. Below the gray line is a faster than normal marketplace. Above is cooler. So we just did a fairly significant improvement recently, going from cooler than normal to hotter than normal, or call it normal. Part of this is going to be involved in the holidays. Going into the holidays, buyers stay more active than sellers, so you have a hotter marketplace. Then you have a flood of inventory coming on the market after the holiday, Labor Day, and then you get rid of that inventory and you heat back up to where you are. So I think the fluctuation that you're seeing right here is the holiday bounce, and Labor Day is one of those holidays that moves around, so it's going to be earlier or later depending on the year. But the general trend has been down and improving. So the market has been getting a little bit better than it typically does for this time of the year. Here's your days on market marketing time for 75% of the sellers. You're basically right at the normal marketing time. We went through a little bit of a slowdown right through here. I know a lot of my associates in the industry are blaming it on the compensation change on August 17th. I don't think that impacted the marketplace at all, but something caused it to slow down the second half. Now, maybe buyers were waiting, maybe sellers were waiting, but I think it's a non-issue. Whoops. Here is the price reduction. This looks more normal, where you're a little bit on the hot side of 100%. This is the median overbidding. So you can see that the amount of overbidding that the buyers are doing, so the competitiveness they're feeling, is a little bit higher than normal. You're up here somewhere around 3.25% overbids. And this is the median overbid. The average overbid was up here around 5.5%, 5.7% or something like that. Average is always going to be higher than the median. Here you can see the overbidding is, looks like it's plotting correctly. It's higher than you'd expect it to be for this time of the year. Here's the frequency of overbidding, a little bit more frequent because you're slightly above the gray line, but basically following the normal pattern. So a little bit above, following the normal pattern. Here is the long-term appreciation. This is just a freehand slope of the average appreciation rate. Notice the V at the end of every year, and then the upside down V. Sometime halfway through first quarter to halfway through second quarter, we had the V a little earlier, the upside down V, and now we're getting a little bit of appreciation because we overshot again, potentially for whatever reason. The market slowed down earlier this year. Here's your payments on your most expensive 10 percentile, your typical home coming in at about $11,750 roughly, and then the cheapest 10% home coming in at around $6,200 maybe. Here's the three counties, your active inventory. Alameda County has the most inventory. Santa Clara County is the next most. These two are normally closer together, so Santa Clara County has a shortage of inventory compared to the three. In other words, San Mateo County down here in the orange, Alameda County in the gray are closer to normal, it looks like to me, than Santa Clara is to its normal. Here's offers accepted, and Santa Clara County has the most offers over Alameda County. They're normally very similar like they are, but because Santa Clara County has so much less inventory, the speed of the marketplace is going to be quite a bit higher. And so here's your speed. Santa Clara County is the fastest. Alameda County is the slowest, and San Mateo County is is in between the two at about 44 days. Here's the marketing time. And again, Alameda County is the slowest. San Mateo County is in the middle. Santa Clara County has the fastest marketing time. Here's price reductions. Very close together. All three are basically on top of one another. I won't even try to separate them. I mean, they're 99 to 99.1%. Here's your frequency. Again, Santa Clara County and San Mateo County are very close together, about 14.5%. Alameda County is clearly a little bit more price reductions at about 18% of the sellers doing price adjustments. Here's buyer overbidding. Alameda County is having the most overbidding. So even though it was the slowest county, it gets the most overbidding. So for some reason, the buyers are feeling more competitive in Alameda County than they are in either Santa Clara or San Mateo County. Here's the frequency of overbidding, very close together. Santa Clara County has the least frequent overbidding. San Mateo and Alameda County are tied. All three are close to tied. Santa Clara County's got the most appreciation at basically 95%. Alameda County and San Mateo County are very close together, about 70% appreciation since 2015. Here's your long-term price, and this is on log paper. I drew the horizontal to show you that both Santa Clara and San Mateo County are above their 2023 pricing. Alameda County is right at their 2023 pricing. Here's the same information on regular paper. Here's those estimated payments. San Mateo County is the most expensive county. Santa Clara County is the second, and Alameda is the most affordable. Here's your volume of sales. We got the third lowest number of sales last year, but 2 years ago in 2022, we had 2,100 sales. We have 2,138. This will drop below 2,138 with the TFTs coming. So we won with that book, the second lowest number of offers. Here's your data for those that like to look at raw numbers. We have been talking about Silicon Valley real estate market analytics for September 28th. We will be going over the Greater Bay Area, which is 13 counties discussed in 5 regions next. If you want to go to the YouTube archive of these videotape sessions, you just type in the blue URL here. If you want less typing, you type in this green root URL. The green root URL, by adding 2024 to the end of it, you can join the presentation live Saturday morning at 9 a.m. If it asks for the passcode, it's right here for you. The handout is posted, and you get to that by putting in the green root URL plus H for handout, 2024 09 28 for today's year, month, day code. And any specific episode, you can type in the green root URL plus 2024, the month and the date that you're looking for, or just go to the channel and click on it through the channel. I'm Richard Calhoun, real estate broker with Creekside Realty. My contact information is here. I would appreciate it if you would subscribe if you haven't already, and appreciate it if you would like each video that you watch. I represent buyers or sellers in Silicon Valley. Happy to answer any questions you have about the market or your real estate needs. Moving on to the Greater Bay Area. That includes Region 1, which is Silicon Valley, which we've already talked about at length. I add in San Francisco and Marin, which I often refer to as the cities. North Bay, which is Sonoma, Napa, Solano, and Contra Costa County. The Central Valley, which is San Joaquin and Sacramento. And the Central Coast, which is Santa Cruz and Monterey. Here are the 5 regions showing the active inventory. Central Coast and the cities are smaller in housing stock, and therefore they have less inventory. You can see their inventory is down from their historical norms, which are just above and below 1,000. Right now, they're just above and below about 800. So they're running about 20% of the inventory they normally do. Silicon Valley probably has the most normal inventory, because normally it would probably be somewhere around 3,000, and we're sitting here at about 2,700, it looks like. So, you know, it's getting pretty close. It's within about 10% of where it normally is. The gray line being North Bay and the yellow line being Central Valley are very close together, as they traditionally are, but they are also lacking inventory. They may normally be up somewhere around 4,500, and they're down around 3,000. So they're missing about a third of their total inventory. So they're missing the most inventory out of the 5 regions. Now we move on to offers accepted. Even though Central Valley and the North Bay had way more inventory than Silicon Valley sells more houses. So not only are we selling more, our turnover rate has to be much faster than them because they have more inventory. So Silicon Valley is the fastest marketplace by far. You can see that Central Coast and the cities is probably the closest to the normal level of offers. And the Central Coast is probably fairly close, but not as close as the cities. Now you're looking at the speed of the marketplace, the turnover rate. And of course, as I said, Silicon Valley comes out at the bottom at about 45 days to sell their current inventory. I think the exact number is 44 from earlier. Then you have a 3-way tie basically at 60 days, being the cities, the North Bay, and the Central Valley. And the slow area, the area that would take the longest to sell out, is the Central Coast at about 86 days to sell out their inventory. This is marketing time, a very related item, but clearly slightly different. This is simply the time that it takes 75% of the sellers to sell. So only 25% of the sellers take longer than this. In Silicon Valley, that number's around 27 days. In the city, that's about 36 days. In the Central Valley, it's about 42 days. In the North Bay, it's about 54 days. And finally, in the Central Coast, it's 59 days. The big takeaway is notice how all 5 regions are climbing except the cities, which is actually decreasing. So the cities is bucking the general trend of marketing time and taking less time to market their properties than it was just 7 weeks ago or so. Here's ask price reductions. So this is a measure of the seller's expectations compared to market realities. Sellers want to price their property correctly, and if they read the market correctly, they'll sell it without doing any price reductions. The more price reductions, the more they misread the market compared to what the reality of the market is. So Silicon Valley is pretty close with less than a 1% price reduction. Then you have the Central Valley at somewhere around 1.4%. Then you have both the cities and the North Bay coming in with about a 2% price reduction. And then the one area that has the region that has the most price reductions is the Central Coast at somewhere around 2.8% of a price reduction. Now, keep in mind, in all these areas, only a fraction of the sellers do price reductions. A large percentage of the sellers do no price reductions whatsoever. And that we see here, and this is the frequency of price reductions. So the most frequent price reductions are up here, and you basically have a 3-way tie. Yes, Central Coast is the slowest with the most price reductions at about 33% of the sellers. And then it looks like you have Central Valley at about 32% and the North Bay at about 30%. But that's pretty much a 3-way tie for most price reductions, the most frequent price reductions, at just under a third of the sellers taking a price reduction. Then you jump down to the cities, and it's just under 20%, and about 19% of the sellers are doing a price reduction. And the area that has the least price reductions is Silicon Valley at about 16% of the sellers doing a price reductions. Here it's a little bit mixed. You can see the cities was going down and now it's going back up. Silicon Valley was going up and right now it's coming down. Central Coast has been increasing. Central Valley's been increasing. The North Bay has been increasing, but turned around and did a reduction in the last couple of weeks. Here's the magnitude of the buyers overbidding. So this is how much are buyers overbidding, and they're overbidding the most in not the Silicon Valley as you might expect, but in the cities at just over about 6.5% over the seller's ask price. And this is average. The median would be lower than these numbers. Silicon Valley is about 5.9%, and I believe its median is 3%. So you can see that it's almost a 2%. Actually, it might be 3.9. So it's about a 2% increase between the median and the average. And the average is going to typically be higher than the median if you have a number that's capped on the low end and can go up to infinity on the high end. It's just the way distributions tend to work. Then North Bay is down at just 0.2%. I'm sorry, that's about 0.5% above ask price. Then you have the Central Valley right at the seller's ask price. Basically, it's probably 99.9%, so 0.1% price reduction. And then you have the Central Coast doing almost a full percent price reduction at the time they bring in the offers. In other words, the offers are 1% lower than the seller's ask price. Here's the frequency of overbidding. The overbidding is the most common in Silicon Valley. And you can see basically all these numbers are coming down except for the cities, which bounced up the last couple of weeks. And that's general trend because actually the cities has been flat or slightly down the last week, but in general, it's been an upward trend. But 4 out of the 5 regions are on a downward slope. Silicon Valley is getting about 65% of the sellers, maybe even 66%. So 2/3 of the sellers are receiving overbids. In the cities, it's about 58% of the sellers, or closer to 57% of the sellers getting overbid. North Bay, 44%. Central Valley, 40%. And the Central Coast, that even though they're taking a 2% price reduction on average, still 34% of the sellers are receiving an overbid. Here's the long-term appreciation, with the big takeaway still being the cities being the lowest by far at only about 35% appreciation. The Central Valley has the highest appreciation at about 92% appreciation. Silicon Valley and Central Coast are very close together at about 84 and 82%. and North Bay is coming in at about 62%. That's appreciation since 2015, the last 9 months. Then we're looking at the current sold price. Silicon Valley and the cities are basically on a dead even. Then you have Central Coast, North Bay, and the most affordable region is the Central Valley. Here's the monthly payments in the same order. This assumes an 80% 30-year fixed at the national rate published by the Federal Reserve Bank. Here's the actual numbers. You can look at your metrics across the top, your city, your counties or region for Silicon Valley. The only other region I have on there is the Bay Area. I do that only because the media does talk so much about the Bay Area real estate market. I don't believe it's accurate, and you can pick any metric on here you want. You know, just look at the median days on market, anywhere from a low of 9 in Santa Clara County to a high of 39 in Napa. So basically 4.5 times is great marketing time. So how you can say, or look at something different, what would be, look at frequency of overbidding, anywhere from a high of, looks like actually 72% down here in San Francisco with the most overbidding, to a low of 22% in Napa. Those two counties are not going to be at all similar, and to put them in a blender and talk about the weighted average for the whole 9 counties that touch the Bay is essentially a garbage number. It's an accurate number. It reflects what's happening, but it's something to give you any indication of what's going on in any given area. With that, again, I'd like to thank you for your time. Appreciate your likes and subscriptions. If you have any questions, feel free to reach out to me. I'm not seeing any unmuted mics, so